Good morning, everyone. My clock shows 10 o'clock. So let's get started. It's time for another DWD webinar. Today, Carrie's going to talk about nonprofit compliance. So for our new viewers, I'm going to take a moment to introduce our team here at DWD. My name is Tyson Moore. I'm an accounting supervisor. Joining us today is senior accountant Audrey Lemon and partner Carrie Minnick. Just as a reminder, this webinar is live, it's interactive. So if you have questions, you can use Zoom's question and answer feature. It's at the bottom of your screen. We will be answering your questions throughout the webinar. Also, Carrie's slides, they'll be emailed out to everyone who attended today once the presentation is finished. That being said, I'll turn it over to Carrie to get us started.
Thanks, Tyson, and welcome everyone. As Tyson said, today we're going to talk about nonprofit compliance requirements, which basically means what you need to make sure that you do in order to keep your tax-exempt status. We've divided this into 3 different categories that we're going to talk about today: the federal level, the state level, and the local level. I think most of you are in Allen County, but for those of you that are not, the Allen County things that we talk about will probably apply to wherever you're at as well. It's just going to be specific to Allen County as far as the details. So let's get started. So when we talk about the federal level with the IRS, the main thing here is that your organization, when it initially applied for tax exempt status, the IRS approved your purpose. So you provided them an explanation of what your exempt purpose was. For example, the 501c3 organizations need to be operated exclusively for a specific exempt purpose. So you need to make sure that you don't stray from that exempt purpose. One of the questions on the annual form 990 is, has there been any changes to your programs during the year? And if there are significant changes, we do need to report that to the IRS. So that way the IRS is aware of any of those changes, especially those that may vary from what you initially put on your tax exempt application. When the IRS accepts your 990, they're basically approving those changes and saying, yes, what those program changes does fall into what your exemption is. So you want to make sure that you're not straying too far from that initial exempt purpose. As a 501c3 organization, there are some things that you need to make sure that you do, but there's also some things that you need to make sure that you don't do. One of those is political activity. So 501c3 organizations are absolutely prohibited from directly or indirectly participating in political campaigns. This means that your organization cannot make contributions to political campaigns, cannot make public statements of position. So you can't say that you should vote for this individual or this individual, either on your website, verbally written, any type of support for one candidate over another. Now, there are certain types of voter education activities or activities that encourage people to vote that you can certainly do. In those instances, you just need to make sure that you have both parties there to make it more of a neutral playing field. And again, it's more of providing education on the voting process and the different issues at hand versus trying to encourage people to vote one way or the other. Next is lobbying. Lobbying is a little different than political activity. 501c3 organizations can engage in some lobbying. However, really it should not be a substantial part of your activities. So lobbying is more attempting to influence legislation as opposed to coming straight out and saying, vote for this candidate or this candidate. So again, you may engage in some lobbying. However, too much lobbying activity is a risk that you may lose your tax exempt status. So if you do participate in any kind of lobbying within your organization, you just might want to evaluate that and determine how much that is in comparison to your overall activity. And I just want to mention too that then there is also, aside from political activity and lobbying, there is the process of educating people on the different topics and issues that are being voted on. So if you are just merely educating people on, hey, you know, this is an issue and this is how this issue is going to affect our organization and those people that we serve, that's perfectly fine. Again, that's more of an educational type of thing, not lobbying or political activity. So you are certainly allowed and encouraged to do that, to say, okay, you know, these are the topics at hand, and this is how it's going to impact our work as a nonprofit organization. The earnings of a 501c3 organization, you need to make sure that they do not inure to the benefit of any private shareholder or individual. So basically, your organization as a nonprofit needs to exist for the benefit for the community as a whole. So that means that there are certain individuals, like specific individuals, cannot benefit from your organization's activities. Oftentimes when we talk about these, we talk about like those that have control over the organization, whether it be board members or officers or key employees. These individuals are more likely to have this type of, or to get into this type of issue because of the relationship and the control that they have over the organization. If there are issues where an individual is specifically benefiting from their relationship within the organization, then there are excise taxes that are incurred not only on the organization, but also on the individual. So you just want to make sure that any type of transaction with individuals that make decisions for the organization, whether it be key employees, your CEO, CFO, those board members, that they have a conflict of interest, assigned conflict of interest in place, and that is all documented and approved by the board. And similar to that, 501c3 organizations must not operate for the benefit of private interests. So this is very similar. An example here would be maybe an organization provides scholarships, and scholarships are awarded to the children of a board member to go to college. So that's really not it could be seen as that individual benefiting from their relationship serving as an officer or a board member. So again, we just want to make sure that any kinds of transactions with related parties are documented, reviewed, and approved. As an exempt 501c3 organization, you must not operate for the primary purpose of conducting a trade or business that is not related to its exempt purpose. This is unrelated business income. So I'm going to take a minute here to talk about unrelated business income. First of all, 3 things must be in place for it to be considered unrelated business income. It must be a trade or business, it must be regular carried on, and not substantially related to the exempt purpose of your organization. The IRS does not care what your organization is doing with this revenue. So it doesn't matter that all of the revenue, all of the proceeds are going back into the organization to further the exempt purpose. They look strictly at what activity was used to create this, to generate this revenue. And if all 3 of these things are in place, it's probably considered unrelated business income. Now, a small amount of unrelated business income is fine. It's a great way to add additional funds to your organization. However, the IRS does not like it when you have a significant amount of unrelated business income, because again, you received a tax exemption from the IRS, which means you don't have to pay income taxes because of a specific exempt purpose. If you have too much unrelated business income, then you're not paying you're competing with those for-profit entities that are doing the same thing. Now, you do have to pay unrelated business income taxes on unrelated business income. So we take the gross amount of unrelated business income and we reduce it by a $1,000 standard deduction, and then we reduce it by any type of related expenses, and we come down to a net UBI. And then that net amount is taxed at the same corporate level as any other for-profit business. So the IRS sees that if you have too much unrelated business income, then you're probably really not focusing on your tax exempt purposes, and that you're more of a for-profit. Now, when we talk about unrelated business income, it is a very, very gray area. An unrelated business income activity for one organization might not necessarily be considered an unrelated business income activity for another organization. For example, if we have a nonprofit and their purpose is to help individuals that have served time in jail to get back into society and provide them with job training skills. Let's say this organization has a coffee shop and they employ these individuals, these people that have served jail time, and they employ these individuals in this coffee shop in order for them to gain job skills. This coffee shop is run entirely by these individuals, so the organization does not hire anyone else to run this or to run this coffee shop. So in this case, this coffee shop would be considered a program because it's providing job skills to these individuals. Now, let's say we have another nonprofit down the street, and they're providing education services to people, maybe those that need additional education requirements to get their GED. And let's just say that they have a coffee shop to bring in some extra money. The individuals that are going to get their GED are not employed and do not work at the coffee shop. It's just an additional source of revenue that they have and something that they offer to people that come to their organization. In this instance, that coffee shop would likely be considered unrelated business income activity because it really has nothing to do with their main purpose, their exempt purpose. It's a business, it's generating revenue, and it's regularly carried on. So when you're looking at within your own organization, you really have to look at what the specific facts and circumstances are around each specific activity. Some examples of common unrelated business income is advertising. So that's normally always considered unrelated business income. So if you are collecting revenue from companies, individuals to advertise in a pamphlet on your website, that revenue is normally always considered unrelated business income. Debt finance rental income, if you have a building and the building has a mortgage on it, and then you're renting out part of that building or that space to someone else to use, that's almost always considered unrelated business income. If you're providing administrative services to another nonprofit, the sale of logo merchandise. I know a lot of organizations will sell logo shirts, hats, and such with their nonprofit name on it. That's really probably considered unrelated business income. We talked about coffee shops, if you're operating a parking lot, if you have online stores. These are normally considered unrelated business income. So again, I just want to make sure that everyone is aware that it's okay to have some unrelated business income. It's fine. You just have to pay taxes on it, but it is a great way to build some additional revenue sources. The IRS just doesn't like it if you have too much. And of course, the IRS does not come out and say what a significant number is. I've seen some instances where it's been like 12% of the organization's revenue, other instances where it's been 80%. So it varies on the facts and circumstances. It's a very gray area. So you just want to make sure that you're aware of where your revenue is coming from and what kind of activities are creating that revenue. Something else that 501c3 organizations, they may not provide commercial type insurance as a substantial part of its activities. I don't think that's really a concern with most of the organizations around here, but that is something that you're not allowed to do. And then, of course, anything illegal or anything that violates fundamental public policy, IRS really doesn't want you to get involved with that. So something else on the IRS at the IRS level is the Form 990. So all nonprofits, excluding churches and specific religiously related organizations, and there are specific requirements to be considered a church with the IRS, have to file an annual Form 990. This is not a tax return. This is an informational return. It has much more on it than just numbers. The form, there are really three different forms for public charities: Form 990N, Form 990EZ, and Form 990. Which form that you file really depends mostly on your revenue and assets. However, there are some types of specific nonprofits, such as supporting organizations, that are not allowed to file a Form 990N or EZ and must file a Form 990. You can always file a Form 990, even if you're allowed to file a 990N or EZ. All private foundations are required to file a 990PF. So this is must be required or must be filed annually with the IRS. So you do want to make sure that you get your form in. And here's those of you that are have filed the 990s before. You can see the 3 different versions, excluding the 990N. So again, with the annual filing requirements, the 990 is due in the 15th day of the 5th month after the close of the tax year. So that's May 15th for December year ends and November 15th for June year ends. There is a 6-month extension. So if you for some reason can't get that in by the deadline, there is an automatic 6-month extension. However, you do have to file an extension by the due date in order to receive the extension. All returns must be filed electronically. If you file it on paper, you will get a notice from the IRS saying that you have not filed your return. There is a late fee, and they will certainly give you those penalties, and you will get a notice if you have not filed it on time. The late fees do vary based on your gross receipts. If you fail to file your 990 for 3 consecutive years, your tax exempt status will be automatically revoked. If your tax exempt status is revoked, that means you are no longer a nonprofit. Individuals who donate to you can no longer take those as a contribution deduction on their 1040. Most grantors, foundations will no longer provide support to you because you lost your tax exempt status. You will technically be considered a for-profit, so you really should be filing a for-profit tax return and paying taxes on your income. So we really do not want this to happen. I think this is probably the most common way that nonprofits do lose their tax exempt status, which is simply by failing to file that 990 each year. If for some reason that you do lose your tax exempt status because you fail to file your 990, you can reapply. You do have to go through the whole process again, the 1023 or the 1023 EZ. So that does take a bit. As we know, the IRS isn't quite very fast on approving those. I think I looked yesterday, and I think they're about 9 months behind on approving the 1023, which is the tax exempt application for those organizations that have more than $50,000 in gross receipts. So we really can't stress this enough. Want to make sure that you get your 990 filed by the due date. Okay, employment taxes. So again, if you are a nonprofit organization that it has employees, you have to withhold and pay payroll taxes just like any for-profit that has employees. So you're responsible for the federal employment taxes, the FICA. If you are a 501c3, you are exempt from paying FUTA. So that's the federal unemployment taxes. Other nonprofit organizations that are not a C3, I'm sorry, you do have to pay FUTA. So if you're a C3, you are exempt. You will have to file those quarterly tax returns and the annual tax returns, depositing the taxes, issuing W-2s and so forth. So there is no exemption for employment taxes for a nonprofit. Something else at the federal level is written acknowledgments for contributions. So as an individual that wants to take a deduction on their individual 1040 for a contribution, they are required to have a written acknowledgement for any amounts $250 or more. It is their responsibility to get that written acknowledgement from the organization. However, it's really best practices that nonprofits just provide this to their donors automatically. It just makes the donor's life a lot easier. And it's really something that you should be doing anyways, kind of as an additional control, confirming with the donor that you did receive that donation. Now, for quid pro quo contributions of $75 or more, it's actually the organization's responsibility. You are required to provide documentation to the donor. Quid pro quo contributions are instances where perhaps you are having a fundraising event and you sell a ticket for $100. Of this $100, $20 goes to cover your meal and $80 is a contribution. So part of that, the donor's receiving something in exchange. So in that instance, the nonprofit is required to provide written acknowledgement to the donor. And you have to include how much of that is tax deductible, or how much of it is a contribution versus not in that written acknowledgement. You also should include the name of the organization, the amount of the cash contribution. So, if it's a straight all contributions, you say $100. If it's where you get an exchange portion, you're going to say $80, $20 is non-deductible. If someone does provide you non-cash contributions, so for example, you collect clothing for a clothing bank or food for a food bank, or even somebody's just donating like paper for your copiers, you should still send them a thank you note saying, thank you for, and then provide the description of what they donated. It is not your responsibility to provide the dollar amount, so do not be putting that into the written acknowledgement you're sending your donors. It is their responsibility to determine the value for their taxes. Also should be included as a statement that no goods or services were provided to the organization, if that is the case. However, if there was a goods or services provided, then you should provide a good faith estimate as to that value. So again, going back to that ticket for a fundraising event, this would be the $20 meal value. That's what they're talking about there. Also, the IRS requires some public disclosure items. They give you a tax exemption from paying income taxes. So in return, they are asking you to disclose some items to the public. Your Form 990 for the last 3 years should be available to the public. Many organizations will put this on their website, which is perfectly fine. However, if someone does contact your organization and request a copy of your 990, you do need to provide that to them. There's actually a fee penalty if you don't provide that to them within a reasonable amount of days. When you're providing your 990, make sure that you do not include the names and addresses of the donors on Schedule B. That is not open to public inspection. We want to respect the privacy of our donors. So Form 990 and all the other schedules should be made available except for Schedule B, names and addresses of donors. And I know when we prepare the Form 990 for our clients, we provide them a public disclosure copy of Form 990 that has this information redacted. So they actually have 2 copies of the 990, so they can easily provide that to anyone from the public asking for a copy. Also, your application for tax exemption, which is your Form 1023 or 1023-EZ if you're a 501c3. If you're another type of tax exempt organization, that would be Form 1024. So that would be the initial application that you probably filed many, many years ago with the IRS. That's actually supposed to be available for public inspection. All right. Moving on to another federal entity, the Office of Management and Budget, the OMB. Some of you are probably very familiar with OMB, while others may not be so familiar. For those organizations that receive government funding, you should be familiar with this. So if you are a nonprofit that expends $750,000 or more, and this actually just increased to $1 million effective October 1st, during the year, you must have a single audit conducted. So a single audit is a little bit different than a financial statement audit. So we come in and we do the financial statement audit, but then there's an added compliance piece. Within a single audit, we look at not only the financials of those government fundings, but we have to perform additional testing over controls and compliance, making sure that those funds that you received and spent were spent for that they were reported properly, they were spent for what they were supposed to be spent for, all of the controls are proper related to that. So if you get government funds, and this is specifically federal funds, however, you need to be careful because sometimes federal funds flow through down to a city or a state or another nonprofit and then to your organization. So we're looking at the initial source of funds. So if the initial source came from the federal government and you expended more than $750,000 or $1 million going forward, then you will require a single audit. There's an annual compliance supplement that the OMB issues every year, and it lists nearly every government grant that the government issues, and it talks about different compliance requirements that grant includes, who is eligible to receive that grant as far as when you're giving it out when you're serving the public. What kind of costs and expenses you can spend that on. If there are any requirements on whether you can spend that money on fixed assets or capital items. So this is what we use when we perform those audits. So if you do get government funding, that should be something you're familiar with, or if not, go and take a look at that compliance supplement. At the end of the single audit, you are required to upload both the single audit report that the auditor gives you, as well as the form SFFAC, which is the data collection form. Both of those get uploaded to the Federal Audit Clearinghouse, and that is a federal website that is available for the public to look at. So, and again, that all needs to be done within a certain time frame after the year end. So if you do get federal money, you are required to have this single audit done. So make sure that is getting done. Not all CPAs are eligible, can do single audits. There is specific education requirements that must be met in order to do that. So if that's something that you think you might need in the future, you might want to plan for that. It does take a lot more work and is more costly than a regular financial statement audit. This is what the first page of the compliance supplement looks like. Again, they do issue one every year. Sometime May, June is kind of when they try and do it. However, it doesn't always get issued at that time. This is the Federal Audit Clearinghouse. This is the website that you go and upload those documents to at the end of the audit. This is also a website that anyone from the public can go and search for your audit financial statements and look at those as well. All right, so moving on to the state of Indiana, we're going to start with the Indiana Secretary of State. And if there are people joining us from other states, I'm sure that the requirements are very similar in other states. However, this is specific to the state of Indiana. So the main thing with the Secretary of State is filing that business entity report. It must be filed every other year to maintain your business's active status with the state of Indiana. Basically, you're just telling the state that, hey, yep, I'm still here, and this is who you should contact, and this is our address. It's due the month and the day that the business was formed or registered, and you have until the end of that month before it's considered past due. There is a small fee. It used to be that filing online was cheaper than on paper, but they've switched it. So it's actually more expensive to file on paper. However, I would encourage everyone to file online through InBiz. If you do not file this report, you will be administratively dissolved, which is bad. We don't want that to happen because you're going to have to go through the whole process of being approved by the state of Indiana again. They are nice and send out reminders 90 days and 30 days prior to the report being due. However, they will send it via email to the registered agent that they have on hand. So if the individual, that registered agent has changed, and the state does not know that, that email might not go to the correct person. So you just want to make sure that you know who the registered agent is and watch out for that email as a reminder. It's a pretty easy form. Basically, it just reports the address, an individual's name, who's the registered agent, your address, business email, and then officers of the organization. So it's a pretty easy form to file. Again, it's due every other year. It used to be due every year, but they've changed it to every other year. And it is filed through InBiz. So this is their InBiz website. So hopefully you already have an account set up with them, so you can just go in there and easily file that report. Okay. Next is the state of Indiana, the Indiana Department of Revenue. So if you didn't know, the actual Indiana code has a couple things that do apply to nonprofit boards. First is that all nonprofit boards must consist of at least 3 individuals. So if you do not have 3 individuals on your board at this time, you might want to go recruit some more board members. So that's the first thing. The second thing does say that you must have a president, secretary, and treasurer. So if you do not have officers with those titles, you might want to consider electing officers with those titles. Also, normally the bylaws don't really have a lot of requirements in them. Basically, they're your internal rules of the organization. However, the state of Indiana does say that the bylaws must delegate one of the officers the responsibility for preparing minutes and authenticating records of the corporation. So basically, this is your secretary. So they're just making sure that you are keeping written minutes because that is a requirement of the state. So making sure that you do maintain written board minutes that do include what was discussed and any pertinent decisions that were made and approvals, those do need to be maintained by the organization. Okay, next let's talk about sales tax. And if anyone is already involved with sales, either purchases or sales, which I'm sure all of you are, you'll know that there was significant changes in Indiana in July 2022 to sales tax. So first, just basic, we'll talk about purchases by nonprofits. To qualify for a sales tax exemption on purchases, a nonprofit organization must use those for their exempt purpose. So this is how the rule has always been. So as a nonprofit, when you go out and purchase items, in order to not have to pay sales tax on them, you have to use those items to carry on your nonprofit's exempt purpose. So it can't be used, for example, like if you're buying a gift for a board member that's retiring, that is not part of your tax exempt purpose. So it needs to be used directly for your exempt purpose. Also, it must be invoiced directly to the nonprofit. So if you are an organization and you are having your employees go out and purchase items at Walmart for supplies, technically those, and they're paying for it and then you're reimbursing that employee, technically those payments made by employees and being reimbursed by the organization should include sales tax because the employee is the one that's purchasing it, not the organization. So I know there are some instances where it's just easier for your employees to make the purchase and then you reimburse them. But really we recommend best practices is to have the organization make those payments. So have the invoice sent directly to the organization and then they make the payment. So in order to be exempt from sales tax, an organization, after you receive your tax exempt status from the IRS, you have to apply to the Indiana Department of Revenue to receive and be approved to be exempt from sales tax. It used to be that you had to file NP 20 every year with the Indiana Department of Revenue to maintain that sales tax exemption. This is what has changed, one of the things that has changed. So in July 2022, they said, okay, we're not doing this anymore. No more NP 20. So instead, we are going to file NP 20R, and we are going to require it to be filed electronically through InTime. So your organization needs to file this form through its InTime account, and it's going to be filed every 5 years instead of every year. And so as we make this transition, they are going to kind of grandfather in the due dates for the organization. So if your EIN starts with 0 through 24, your first NP 20R was due May 15th, and then your next one is going to be due 2029. And you can see the due dates for each of those EINs. If your annual report is not filed within 60 days after receiving or after the due date, then the organization's exempt status for sales tax in Indiana will be canceled. So this is something that you want to make sure that you do file because being exempt from sales tax is a nice benefit that nonprofits have. So just making sure that you are filing those going forward. For those of you that we prepare the 990 for, we used to prepare the NP 20. However, moving forward, we will not prepare the NP 20R because it does need to be filed electronically through the organization's InTime account, and we do not have access to all of those. So that will be something that you will need to do moving forward. Okay, so let's talk about the other side now, sales of items by a nonprofit organization. So general rule is that sales tax must be collected and remitted by anyone that sells tangible items in Indiana. Okay. Now, when we think about tangible personal property, that would include sales of merchandise. So if you're selling like swag that has your name on it, if you're selling tickets to a gala, a fundraiser that includes food and drinks, technically that is tangible items that could include sales tax. However, there is a de minimis rule here that's on the screen that you can apply. But one thing that some people might not think about is the silent auction items. If you are selling items, not the experiences, but like if you are selling actual items like a signed football or, one of those little kids tractors that's real nice. If you are selling physical, if you are auctioning off physical items in a silent auction, those are technically tangible personal property that you should be collecting sales tax on, which I think a lot of people do not do. Now, however, there are some exceptions. So it used to be prior to July 2022 that there was a 30-day rule. So if you sold an item for less than 30 days during the year, you did not have to collect sales tax. That changed. So we're going to go away and we're not going to do that anymore. We're going to say if you reach $20,000 in sales, then you have to collect sales tax. And then they said, okay, no, we're going to change that again. We're going to do $100,000 in sales. So the rule now is once you hit $100,000, so this is for the tax year, for January 1 to December 31. Once you hit $100,000 in sales, that is going to trigger you to have to be registered to collect and remit sales tax. You then have to continue to collect and remit sales tax until you make less than $100,000 in sales for 2 consecutive years. So if you have an event, or let's say you have an event at the beginning of the year and you have a whole bunch of auction items and you did really well and you sold $80,000 worth of items. Okay, so you have $80,000 of sales. Then let's say mid-year in June, you have another event and let's say you sell $30,000. Okay, so 80 plus 30, that's more than $100,000. So now because you're over $100,000 in sales, if you sell anything else the rest of the year, you have to collect sales tax on it. So that second event in June triggers you to have to register and collect and remit sales tax. You do not necessarily need to collect and remit sales tax on that $30,000 because going into that event, you were less than $100,000, but going out, you were. So then let's say later in the year, you sell $500 worth of t-shirts. That $500 worth of t-shirts technically should have sales tax collected and paid on it. And then in next year, because you had over $100,000 in sales this year, next year you'll have to collect and remit sales tax. And again, for the next year until you're less than $100,000 for 2 consecutive years. So it's a little confusing. I don't know that they did the best job in explaining the changes. There is a really good sales tax bulletin out on the Indiana Department of Revenue for nonprofits that I would recommend looking at that gives lots of different examples on different situations on when sales tax should be collected and remitted. So something to look into if you sell any types of items or have any types of fundraisers where you are auctioning off tangible items. Now, there are some rules though. So even if you are an organization that does have over $100,000 in sale, if you are a church, a monastery, a convent, Indiana public schools, parochial schools that are maintained by a recognized religion, or youth organizations focused on agriculture would be like FFA. Those organizations are specifically exempt from collecting and paying sales tax, even when they reach that $100,000. So if you are one of those organizations, you are lucky and you don't have to worry about ever collecting sales tax. So again, I've put the link and the name of those 2 sales tax bulletins. I'd highly recommend you go look at on the Indiana Department of Revenue's website if you have any types of sales. So again, just making sure that you are in compliance with those. We talked about unrelated business income taxes at the federal level. So again, at the state level, so when you get unrelated business income and you have to pay taxes on it, there's a form that you have to file at the federal level, Form 990T. That reports that income to the IRS. And then also it would calculate how much you need to pay, and then you would make that payment. So at the state level as well, there's a form IT-20NP that reports the state income taxes or unrelated business income taxes that you do have to pay. There also, if you have over a certain dollar amount, you might have to make estimated tax payments. So just know again that if you have unrelated business income, you do have to report and pay both federal and state taxes on that activity. Okay, moving on. So local, we're going to talk specifically about Allen County here, property taxes specifically. So as a nonprofit, one of the other benefits that you get is being exempt from property taxes. So just like you don't have to pay sales tax, you don't have to pay property taxes. If you have to apply for the exemption though, and it has to be approved. The property has to be owned, occupied, and used for educational, literary, scientific, religious, or charitable purposes. Just because you are a nonprofit that owns property doesn't mean that that property is automatically exempt from property taxes, even if you file an exemption. I have seen instances where a nonprofit, a 501c3, owns property. However, the property is not being used for the specific exemption purpose. So it doesn't receive an exemption from property taxes, and they do have to pay property taxes. I've also seen instances where they may get a partial deduction. So maybe they don't have to pay the full property tax calculated. They only have to pay a percentage of it based on what it is used for. So again, if you have property, you do need to and want to be exempt, which I assume you do from property taxes, you do have to file a Form 136. It's an application for property tax exemption, and it should be filed on or before April 1st of the assessment year. So if you are already in existence and you already have this in place, you don't have to worry about it. But if you're a new organization, or perhaps you recently purchased new property, so if you bought that new property, let's say you bought it in November of 2024, you just want to make sure that you have that exemption filed by April 1st of 2025 for that. So this really relates to new property that's purchased. Now, there is a personal property exemption that relates both to nonprofits and for-profits. So if you have business personal property that is it's up to $80,000 now. So if you have personal property that's less than $80,000, you can file for an exemption where you don't have to pay property taxes and you don't have to file a property tax return. So under the nonprofit exemption, you are exempt from paying property taxes, but you still have to file the annual return every year. Under this exemption, you don't have to file the return every year. This exemption is different than your nonprofit exemption. If you choose this $80,000 exemption, your nonprofit exemption goes away. So the nonprofit exemption kind of overrides this one. So if you want to use this one instead, then your other one is going to go away if you already have it, because this is something new. And that's fine. However, once you reach 81,000 or 80,001, then you're over that $80,000 exemption and you have to start paying property taxes on that amount in excess of $80,000. Most of our nonprofit clients will use the nonprofit exemption as opposed to the $80,000 exemption. It's easier that way. They don't have to worry about how many assets they have. If they go over the $80,000, they're covered by the nonprofit exemption, not the $80,000 exemption. Obviously, it's totally up to the organization what they want to do, but just know that if you do file for this $80,000 property tax exemption, your nonprofit tax exemption does go away. Something else to keep in mind with property taxes is that when you sell property or purchase property from someone else, there really should be a notice of change of ownership for exempt property. So if you are, as a nonprofit, owned property and it had an exemption on it, when you sell it, it's best for you to file this notice with the assessor's office because then that way that exemption will go away. It no longer applies to that nonprofit because you do not own that property anymore. Also, as I said, just because you are exempt from paying property taxes, it doesn't mean you are exempt from actually filing the returns. So you do have to file Form 104 and Form 104 and 103 every year by May 15th. The property tax is assessed on a January 1 date. So basically, it's just listing all of your property. You file the return, you don't have to pay property taxes on it because you're exempt, but they still want a copy of all of your assets. They did recently make a change in Indiana. So effective January 1, 2023, churches and religious societies that have filed personal property tax returns for every year for the previous 5 years are no longer required to file. So if you are a church or a religious society, and it could be kind of vague as to what a religious society is, but they do have some rules relating to that. So basically, if you're a church and you have filed a property tax return for the last 5 years prior to January 1, 2023, you do not have to file the forms anymore. They're good with you not filing those. So that's another benefit for churches. So obviously that is not an all-encompassing list of everything that you need to do or can't do to maintain your tax exempt status, but those are kind of some of the main ones. Again, your tax exempt status is probably one of your most valuable assets, and you want to make sure that you don't lose that. If you do lose your tax exempt status, that's pretty detrimental to your organization. As I noted earlier, you will be required to file federal income taxes on your revenue because you're not going to be a nonprofit anymore. You're not going to be recognized by the IRS to be exempt from that. You can actually, well, here hold on that first for a minute. You will be subject to state income taxes, sales taxes, property taxes. You're not going to receive those exemptions if you lose your tax exempt status. You're not going to be listed on the IRS's list of organizations eligible to receive a tax-deductible charitable contribution. So you can go out to the IRS website under the exempt select check, and it's a listing of all nonprofits that are all tax-exempt organizations that are registered with the IRS. So if someone is looking up your organization, or if they're looking for an organization to give to, they can go to the IRS website and see what your status is with the IRS. So you should go out there and see if you can look up your organization and see what it says. If the organization has had its tax exemption revoked because it did not file its Form 990 for 3 years, it will say on the IRS website when it was revoked. So again, might want to go out there and see what your organization says, what it says about your organization. Donors will no longer be able to deduct contributions, as I mentioned before, on their 1040 because they're not giving to a qualified nonprofit organization. Foundations will probably not be able to make grants because most foundations and donors, government grants, they need to give to 501c3 organizations. And if you lose your tax exempt status, you no longer consider that. And then finally, just the harm to your reputation. If you're a nonprofit organization and you lose your tax exempt status, that's a pretty big deal. Kind of shows that maybe the people in charge weren't necessarily aware of what was going on, what the requirements were. And that's why we wanted to provide you with this webinar today to make you aware of what those requirements are so that you don't lose your tax exempt status. So you don't have to go through all of this. So hopefully this was beneficial to you. Just wanted to share one last thing before we end for today. We do have additional resources on our website. Everything is free. We have our bi-weekly blog. We also have other webinars for various topics. We know that nonprofits sometimes aren't able to find a lot of free resources, so we want to make that available to you. So please feel free to visit our website. Again, all of that is free on our website. Also, if you have questions for any of us, please feel free to contact any of our nonprofit team members whenever. We are happy to be available and help you in any way that we can. And I just want to end by saying thank you for attending today. If you have any questions, please feel free to email us, and we just really appreciate what you do for our community within your organizations. Thank you.